Hi, I'm Jeff Saylor, and welcome to the world's liveliest audit update. In this course, we'll discuss the latest audit standards and related topics. In addition to the nuts and bolts, I'll discuss some bigger picture issues to assist in your overall understanding. I'll also break up the time with some of my video parodies, which are a great way to reinforce the material as well as give you a few laughs. So let's begin by jumping into the latest SAS updates. So we're going to look at a myriad of audit updates that have been issued. And the first one I want to start out with is not really a new one. It's newer, but it's already in place. And my experience is a lot of these things catch you by surprise. So if you're up on this one, I'm happy for you. And if you're not, hopefully I will keep you out of trouble with this one. Our first one is SAS 132, the auditor's consideration of an entity's ability to continue as a going concern. The going concern basis of accounting. It's funny, I've always been a little disturbed by that term basis of accounting. It sounds like it's a framework. No, it's more of a principle. But the going concern basis of accounting is presumed unless the liquidation basis is appropriate. Now, what does that mean? It means that I'm going to be around next year, and the year after that, and the year after that. I kind of presume that we're going to be in business for a very long time. Now, sadly, with what's going on right now, I think that really comes into question quite a bit. And so this is a very, very timely topic right now, this going concern thing. So we're going to presume we're going to be around for forever unless the liquidation basis is appropriate. And what does that mean? Well, that means that the board of directors has sat around and said, you know what? We're going out of business. So what we're going to do is we're going to shift gears and we're just going to come up with a plan for paying off our creditors. And once we're done with that, we're closing the doors. And so you shift to the liquidation basis of accounting, which is a little bit different focus than a general operating scenario. Now that's a GAAP requirement. Now remember, we're talking about audit standards here. That's a GAAP requirement. So what about a special purpose framework? Well, it may not require the assessment. You see, GAAP says management has to assess it. Well, modified cash doesn't do that. Income tax basis doesn't do that. So what's got to happen? Well, that requirement is not really relevant. So it's not really relevant to our audit, but still the auditor has to consider going concern. To put it in simple terms, you kind of have to fall back to the old way we used to do it, where we actually did get involved. So we've got to evaluate the financial statement effects. And of course, that includes disclosure. In fact, that might be one of the most important things we do. So the overall requirements of this standard, this audit standard, exist even if the framework doesn't require an assessment. In other words, if you're auditing income tax basis statements, you can't say, well, I don't have to worry about it because it's not in their framework. That is not correct. So the scope here, it applies to all audits of complete financial statements regardless of the framework. Now, once again, we already mentioned that the FASB codification addresses going concern. GASB 56 also requires an evaluation of going concern, but others may not, of course. So let's look at your objectives. All audit standards have objectives. That's part of the improvement under the Clarity Project. So here we go. We have to obtain sufficient evidence to conclude on the appropriateness of management's use of the going concern basis of accounting when relevant. Now, what does that mean to say that it is appropriate? Well, let's cut to the chase. If everything's fine and dandy, we're making money hand over fist, there's no going concern issues, and management doesn't choose to say anything about it, that actually is appropriate. But oh my goodness, if they're going out of business, they better have a pretty mean, wicked footnote there. That would be appropriate as well, provided they did it. So we have to make sure that they're doing what they're supposed to say in the reporting side. All right, then we want to conclude whether substantial doubt exists, and we'll talk about that in a second. We will evaluate the possible financial statement effects, including disclosures, because yes, there are two scenarios where you will have to have a disclosure, and then report according to the standards. And so we might have to modify our report because of this. Definitions here: reasonable period of time. That is the time required by the framework. And it says if there is none, then we are looking at 1 year after the date of financial statement issuance, or the date that it's available to be issued. Well, believe it or not, that is the time frame specified by the GAAP standard.